higher limits than Navy Federal, $125,000. So for today's video, we have a subscriber request. I know a lot of people were asking about this particular credit card. Now, it is actually a refresh from a video I did several months ago. And back then it was called the Flex Base credit card. Now they dropped the base part of it and it's just Flex. Now, what's interesting about this is that this is a net 60 on all purchases. Now, what makes this different from a lot of the other fintech types of cards is the fact that you get up to 60-day net terms. Now, the way the net terms work, the 60 days starts at the end of the statement period. And the way they work, they have a statement period, let's say in any given month, from the 1st to the 15th, and then from the 16th to the end of the month. So that's actually 2 statements. Right here it says you have at least 60 days to pay at 0% interest on every transaction you make on the Flex card. Now, here's the example they give you, right? So payments are due twice per month on the 15th and the last day of the month for a 2-week period 60 days ago, right? So this example, let's say on April 1st to the 15th, those transactions are going to be due on June 15th. So as you can see, during this period, this 15-day period, right, you can make transactions and then the statement cycle is going to end on the 15th. And then from there, you have 60 days to pay it off in full. So they say you have at least 60 days to pay, but you could actually get more than that depending on how you use the card strategically. So let's say you make only transactions on April 1st, then you won't have to pay that off in full with 0% interest until the 15th of June, which technically gives you 74 days with 0% interest. Now, also, I wanted to just emphasize, right, does applying to Flex impact my credit score? So no, applying to Flex does not impact your credit score. Flex conducts a soft credit pool. Now, you do have to provide your social security number. And I actually went through the process of applying for this card and was approved for a $125,000 limit. So one of the advantages I would say with this particular credit product is that you can actually get a pretty decent credit limit. Now, what I really like about this card is the fact that you could actually preserve your cash flow a lot better, because if you don't have to make payments on your different credit account for a minimum of 60 days, it's going to allow you to stack up your cash, right? And so I think for businesses, this would be very useful because you have a longer time horizon to repay versus a traditional, let's say, you know, a divvy or whatever it's called now, bill, where you have to pay it off every 30 days. With this, you get up to 60 days. So that in itself, I think, is a game changer. Also, the fact that they have these rolling statement cycles. So it gives you a minimum of 60 days at the end of the statement cycle to pay it off in full. But let's say you don't pay it off in full, they'll just apply an APR to that balance. It is a high APR, but again, it just gives you the flexibility. Now, I don't recommend this card for everyone. I think if you have a decent amount of revenue and you have some time in business, then this might be a decent option. But if you're a brand new startup business, or if you don't have that much checking activity or deposit activity, then this probably won't be a good fit. Now, in terms of the data points and how they evaluate you, at least when I went through the process, you did have to connect through Plaid, and they also will ask for hard copies of your bank statements, right? And just to verify the revenue, because it is going to be mostly revenue driven. And if I recall, I actually did have to sign in through QuickBooks as well. So they're taking a holistic view of your business to see not only how much money you're bringing in, but how much money is leaving out. And they use that to determine if you do have the ability to repay whatever amount of credit that they extend to you. There's no impact to your personal credit, so you're not going to get a hard inquiry. However, they do a soft inquiry, and this is mostly for KYC and identity verification. But then once you go through underwriting, they may also request additional documentation such as a profit and loss statement or maybe even tax returns. Now, overall, I would give this a leg up when compared to some of the other corporate charge cards. The only downside is that you don't earn any rewards on the spend. So depending on what your objectives are, if you prefer to have, let's say, some type of cash back, then you might want to go with, let's say, an American Express or any other type of charge card where you actually do earn rewards on your spend. But if you prefer to have a longer window to repay your credit, then this might be a decent option for you. I think it really gives business owners an opportunity to preserve their cash flow a lot better. And overall, when it comes to the business model of Flex, they're really looking for people who are going to be spending on the card and utilizing it. So they're not charging any interest on the balances up to 60 days, but they do prefer customers who are transacting a lot more because, again, since they're not going to be making that much money on interest, they're going to be making money off the transactions and the interchange. So now I wouldn't necessarily recommend this card for everyone. I'm not telling anyone to go out and apply for this. I would say if you're a more established business that prefers to have a little bit more of a time window to repay your credit, then this could definitely be an option for you and help you preserve your cash flow. Unlike some other charge cards where you know you have to pay it off in full every 30 days, this just gives you a little bit more flexibility, hence the name Flex. All right, so a final recap on the data points. Now, again, this is just based off of my firsthand experience. There is a soft credit pull. Now, this is not going to affect your personal credit. This is going to be for identity verification, and this is usually required at most financial institutions. They want to verify your identity. So if you're trying to use some type of CPN or, any nonsense like that, it's not going to go through. And I'm assuming they're probably using Experian because Experian is connected or has APIs with the Social Security Administration. And a lot of financial institutions actually are now preferring Experian because it adds an extra layer of security and verification. Now, you will have to connect via Plaid. So they're going to read in your banking history. On top of Plaid, when I went through the process, they also asked for PDF bank statements. So not only just the Plaid connection, but actual bank statements. So this is just an additional way to verify your information. So they do have an integration with whatever software that you're using for accounting. Now, I'm not sure all the different integrations. I think QuickBooks and maybe Xero, not 100% sure on all the different integrations, but that was part of the process. And you can collect a lot of information just through an accounting software, things like your profit and loss, your balance sheet, your statement of cash flows. So there's a lot of granular information that comes from the accounting software connection. Now, one of the main benefits in terms of the limits, so again, they do have high limits. I was able to get 125,000, but the limits are actually fixed. So unlike a Divvy or a Ramp or a Brex, where your limit can fluctuate based off of your banking activity, now with Brex or Ramp, your limits will either increase or decrease depending on money coming in and money coming out. Now, one of the benefits with Flex is that it's not a dynamic limit. It's actually a fixed limit. So your limit is not going to change based off of what's going on in your business checking account. And I think that's one of the major advantages with this because you have a more predictable line of credit. And when it comes to, the limits, from what I gathered, the limits are going to be somewhat comparable to your monthly revenue. Again, 60 days with zero interest. However, you can get a little bit longer time now, depending on when your purchases are made, but the 60 days does not start into the end of the statement. Now, the way you would get the 74 days with 0% interest, let's say if you made your purchases on the first day of the statement cycle and you didn't make any other purchases, then technically in that scenario, you would have 74 days with zero interest. And last but not least, so profit and loss and tax returns, they may ask on a case-by-case basis. And I would say this is usually going to be if you're requesting a higher limit. Anyways, that's all for today's video. Let me know your comments and questions down below. And until next time, take it easy and we'll talk to you soon. Peace.